Hey everyone, Coach Investor back to another video for today. So let's talk about two stocks in Bill Ackman's Pershing Square Holdings portfolio that I feel are forever buys. Now, if you don't know, it's a pretty small portfolio of stocks. Actually, it consists of only 8 positions. These are the 8 companies: Chipotle, Restaurant Brand International, Hilton, Howard Hughes, Lowe's, Alphabet, Canadian Pacific Kansas, and the other ticker for Alphabet. Now in this video, I'll talk about the 2 positions which I feel are just buys and hold forever. Of course, you might agree, you might disagree, that's completely fine. I'll show you the current state of those companies, those current stocks, the projections for the coming years, what analysts are expecting, the graph later on, then a couple of things from their earlier earnings report. So first up is Chipotle Mexican Grill. Now, of course, some people will say extremely expensive company, right? 44.5 times forward earnings, market cap $61 billion. I mean, to me, too expensive. Okay, fine. I can understand those that are saying that this is just way too high for a restaurant chain, right? Okay, but if we look further, we can see that compared to its 5-year mean, it is actually cheaper. If we want to have a look at a longer time frame, we can do the 10-year. Even the 10-year, it is a bit cheaper when you look at the forward PE. When you look at EV to EBITDA, price to sales, we are a bit more expensive with price to sales at 5.7 times compared to 4 times. If you look at price to free cash flow, we are actually a bit lower there, 44.3 times compared to 61.9 times. So yes, it's cheaper, but still expensive. But there is a reason for that. If we look at what has happened with Chipotle's shares outstanding in the last 10 years, well, shares outstanding are down approximately 24%. If we look at free cash flow per share, that has gone up quite substantially throughout the years, and especially in the last 2 years. And it doesn't stop there. If you look at the EPS estimate 5-year growth rates here, sits at 23%. Now, if we look at the current analyst price target, the average sits at $2,308, which represents just 3.1% upside. Then, if we look at what the analysts are expecting with regards to sales and EPS growth for the next coming fiscal years, sales growth in fiscal year 2024 of 13.1%, but EPS growth of 20.34%, then a bit of the same in fiscal year 2025. So to me, when a company like this can grow fiscal year 2023 EPS 34%, then another 20% in the 2 consecutive years, year-over-year growth that is, I mean, to me, that warrants a high premium. Now, of course, the restaurant business is not an easy one. Actually, it's a very difficult industry to operate in, actually to succeed, survive. If we look at the numbers from Binwise here, what percentage of restaurants fail? Well, approximately 60% of restaurants fail within the first year of operation and 80% fail within the first 5 years. These numbers may seem off-putting, but the remaining 20% of restaurants go on to find long-term growth and success. So of course, with Chipotle already a big brand, an established brand, they know how to operate quite well in a profitable way. This is a big advantage for them. Of course, the food has to be tasty as well, otherwise, well, you'll fail just based on that. Now, in their earlier earnings report, back in October actually, total revenue increased 11.3% to $2.5 billion, comparable restaurant sales increased 5%, operating margin was 16%, that's an increase from 15.1% same year ago. Restaurant level operating margin was 26.3%, an increase of 100 basis points. And diluted earnings per share increased 23% to $11.32. So definitely the bottom line here increasing faster than the top line. Now, if we go and look at the outlook, by the way, they have also bought a bit more shares. If we look at the outlook, for the fourth quarter and full year comparable restaurant sales growth in the mid to high single digit range, 255 to 285 new restaurant openings. That's for 2023, and for 2024, 285 to 315 new restaurant openings. So despite this company being alive for quite a while and actually public for a long time as well, and up 4,000, close to 5,000% since it went public, and if we look at the 10-year, It's up 317%. Despite all that, this company is still trying to grow and grow quite fast and in a very much profitable way. Now, if we look at this stock, the graph here, we can see that yes, here as well, back in mid-October, the stock started to go back higher and higher quite fast, as the Fed might have indicated that there might be some rate cuts or more rate cuts than expected already in 2024. So it went from around $1,800 all the way to $2,300, which was the point where the stock was overbought. Since then, we are going down under the 20-day moving average. We are sitting right now above the 50-day moving average. If you want to look at a better price entry, the 200-day moving average sits at $1,985. So that's company number one. Of course, I can understand those of you that think that this is not a buy for you, too expensive. I don't like it. I think in a couple of years, people will be tired of eating the same thing. But then again, McDonald's have been alive and well for quite a long time. The Big Mac, still a bestseller in my opinion. And Chipotle has been alive and well for a long time as well, serving the same type of food for a long, long time. So no, I don't think that the food is the problem here. Maybe the price you're paying for the stock is. Again, let me know down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe. If not, we'll really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. And now company number two is a company that you can go either way with this one or its main competitor, and that's Low Companies, competitor being Home Depot. Now this is the full picture right now. The last 10 years, we can see that the stock is, again, same story here. PE is a bit cheaper than the 10-year mean. But if you look at the other metrics here, EV to EBITDA, price to sales, price to free cash flow, we are a bit more expensive. Then if we look at a shorter time frame, we are more expensive on all metrics. Now, you might say this company still pays me a nice little dividend. Yes, just over 2% yield. More on that in a bit. But first, let me show you the power of share buybacks. Here again, the last 10 years, they've bought back 45% of their shares. Basically, their shares have come down 45%. Free cash flow per share has increased quite a lot actually in the last couple of years. Here, the EPS growth rate, 5-year growth rate sits at 8.41%. Yes, there is a bit of weakness in the business because of the do-it-yourself component, but we're going to talk about that in a second. If we look at the average analyst price target, that sits at $230, representing 6.33% upside. If we look at the dividend, we can see here that in the last 10 years, the analyzed growth was 20%. Basically, 10 years ago, they were paying you 18 cents. They're now paying you $1.10. If you think 10 years is too long, okay. Last 3 years, 24.1% annualized growth, and last year, 16.22%. So definitely one of the favorites for the dividend investor that also wants some growth. Now, if we look at what analysts are expecting for the coming fiscal years, fiscal year 2024, a down year with regards to sales and EPS. In fiscal year 2025, basically flat-ish for sales, a little increase of EPS by 2%. But in fiscal year 2026, a full recovery, should I say, up 2.4% year over year with regards to sales, and EPS will increase, or they expect it to increase 11.15%. Now, what exactly has happened? So if we look at their latest earnings report, they say here total sales for the quarter was $20.8 billion. Comparable sales decreased 7.4% due to a decline in DIY, do-it-yourself discretionary spending, partially offset by a positive pro-customer comp sales. Now, in my opinion, in 2024, we're going to see a flip. I think we're going to see an increase in DIY discretionary spending. Of course, that's just my opinion right now. Remains to be seen what really happens with interest rates, remains to be seen what happens with macro, but I think the headwinds are behind us. Then with regards to buybacks and dividends, during the quarter, the company repurchased approximately 7.3 million shares for $1.6 billion, and it paid $642 million in dividends. As for the outlook, full year 2023, total sales of approximately $86 billion, which is a bit lower than what they previously guided for. Comparable sales expected to be down approximately 5% as compared to the prior year, previously down between 2 to 4%. Then adjusted diluted earnings per share of approximately $13 instead of 13.2 to 13.6. And so despite all the, let's say, negative sentiment, negative numbers, should I say, in that report, the stock here as well, mid to end October, has rebounded from its lows. Right now, it is sitting at the 20-day moving average. The 200-day moving average doesn't sit that far from the price we're at today, at $209. RSI is still pretty neutral. So of course, you might say, yes, maybe that's why it's a bit expensive, since the stock has maybe run up too fast in expectations of a better year in 2024, but the business itself, the fundamentals, have not caught up with it just yet. Could be very, very well true. And so maybe if you want to open a position in that, if you have a position, dollar cost average, move in that slowly. Look at the upcoming quarterly earnings, quarterly results, guidance for full year. That might tell you a better story. And of course, do look at Home Depot as well. So to conclude, out of the 8 positions for Bill Ackman, I think Forever buys, Forever owns, Lowe's and Chipotle are the ones for me. Do share your thoughts down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.